Morning, everyone. It's Robin. I'm back with the second part in the Basics in Economics and Finance series. And I wanted to walk you through a website that I've come across that has saved me an enormous amount of time. This is Dr. Yardeni's research at yardeni.com. On this page, on the front page, there is a ton of information available on the markets. And there are different categories here that have different data series and charts for you that make it very easy to get a lot of information about the economy in different areas, whatever targeted area you want, in a very short amount of time. What I used to do before coming here, before this was available, is I would pull information from one of maybe 20, 25 different places. I would plot it out in Excel. I would generate my own graphs, and if I needed to do comparisons, I would put it into a database and do some comparisons of data and create some new charts focused on what I wanted to look at. And that was a great exercise because it really helped me to understand the data I was looking at and where to get it. And it's kind of like back when I was taking my math courses in high school and college, the professors would always tell me, don't use a calculator. Learn to do the math first by hand, and then you can use a calculator. But if you don't learn to do it by hand first, you may not understand the concept and be able to apply the concept. And so it was great me having to pull all of that data myself and explore it and tabulate it and make my own charts and draw my own conclusions. But I'm at the point now where I don't really, the exercise of doing that is just more of a chore than anything. And so what Dr. Yardeni has done for us is he's sort of short-circuited that whole process and just put a ton of this information out that you can come and look at any time that you want. So I'm going to jump right into it. So I wanted to start off looking at the financial market. So you just explode this financial market plus sign, and you get the different charts that he's going to provide for you. Now, some of these are provided daily. So I'm going to start off looking at the daily markets overview. Some of these are provided a little bit less often, depending upon the type of data we're looking at. We don't necessarily need a daily update on certain points of data. So looking at the daily markets overview, there's quite a bit here. Anything from the S&P index to bonds to dollars and commodities. So as you can see here, he's plotted out the S&P 500 index. But the second chart in the series is really interesting because it does a month-to-date performance update on different sectors. So if you want to know what's doing well, whether it's energy or financials or industrials, if this is for your investing or if this is for your planning, for your savings and how expensive your consumer goods may be, this is a nice, neat little chart that will tell you the trends since the beginning of the month. And as we scroll down in here, there's one for PEs and VIX. PEs is price to earnings. So it's how much the market is priced, weighted up against how much earnings the companies are giving. And the higher the P to E ratio, the less value there is for the investor generally. And the VIX is a measure of volatility, and some people say it's like a measure of fear in the market or how much people expect the market to be volatile, and it's really a sentiment index. Here's one that I pointed out before, graphed out, and that's the yield curve. And real quickly, that's the difference between the 10-year Treasury yield and the 2-year yield. And as those get closer together and begin to invert, that's a strong sign of economic recession. Because if people are expecting more return for a short-term loan to the government, then they're expecting the economy to be really rocky in the near future than it would be 10 years out when they basically have no information or very little information and expectations about what the economy is going to be doing. And again, a little bit more on the yield curve. Here's the junk bond chart. Basically tells you what the junk bonds did at any point in time and what the yield was on those. It's come down quite a bit from a high of the end of 2015, but you see it started to come back up a little bit again. Dollars and commodities, it's the weighted dollar index, basically tells you what the trade weighted dollar is. You've got the crude oil in here update. You've got the Citigroup Economic Surprise Index, and that's basically telling you, are we going to have some event that we're not expecting to happen based on some indicators that Citigroup has put together. Just a nice little index for you there. And again, notice how all of this data is in chart form. You don't have to take this data and look at a table and try to figure out what's going on, try to pick out the relationships. It's really done here for you. For a visual person like me, this allows me to very quickly, within 10 minutes, get an update on what the market has been doing. So it's a great little, just a great little batch of information to go through on a daily basis. And I'm going to go down here and look at interest rates. And I'm going to look at the federal funds rate. The federal funds rate is the rate put out by our central bank, the Fed. And here's the futures, and that basically is it's kind of an index on what we think is going to happen in the future to the federal funds rate, the 12-month, 6-month, 3-month, sort of a predictor. Here's the actual federal funds rate, and you can see in 2008, right before the crisis, it looks like about 4.25, and it came down after the crisis. And the reason it came down is in order to stimulate the economy during the recession, the Fed dropped interest rates almost a full 5 points. It was about a little over 4 points to try to stimulate the economy, try to add money to the economy and to stimulate lending. And what will happen is between recessions, the Fed will build up their Fed funds rate so that they can try to manage through a recession. And the problem being is that we've had the federal funds rate so low for so long, it's artificially stimulated the economy. So we had a lot of overbuild, I believe, in the market. And slowly, as of lately, you can see this little stair step of the Fed raising their rate. And what that basically does is it lowers easy access to the money. And at the same time, they're also restricting, or they're selling off some of their holdings at the same time and trying to balance their internal balance sheet. There are different things on that. Here's a yield curve again here in this chart. Here is a major events, federal funds rate and financial crises. This is a really good chart. If you want to know what's happening during other financial crises, you can see how the Fed has manipulated the rate during those times. So it's just a good chart to see, what happens during recessions. Now, the most interesting thing is to note that from 2008 to 1960, almost 50 years, the rate had never been so low. So through all of these different crises, the Fed had this tool in their toolbox to lower rates during times of recession. They don't really have that now. See, it's just sort of crawled up a little bit over the last 2 years, giving the Fed only about 2 points of room on their federal funds rate should we enter another recession, which means more than likely, if you look at some of these drops over past recessions, it means more than likely if we enter another recession, the Fed's going to have to go to negative interest rates, which means they're going to have to charge to borrow money, which I think would be pretty much the first time in history that's ever been done. It's going to be experimental. I have a fairly good idea what I think is going to happen. I think it's going to discourage saving and cause people to spend money, and I think it could lead to a hyperinflationary episode because nobody's going to want to keep their money in the bank. I think is essentially what's going to happen, and it's going to penalize savers, and so it's going to take savings out of the market. And those savings are going to be transferred to higher risk areas where people are going to basically it's going to encourage higher risk speculative activity and discourage saving. I'll just leave it like that. So if you're a saver, it doesn't really look good for you based upon this model. It doesn't look like there's a lot of room for you to capitalize on your savings during the next recession. So that's why I've said in many videos looking at this chart, I really want to spend a little bit of time on this because it's a very important chart. The Fed really determines the economy in a lot of cases because they're determining the ease of money in the system. And if you're a saver and you're looking at this chart and they only have a couple of percentage points to fight the next recession, and that means you're not getting a lot for your savings right now. And so what that's doing right now, it's pushing people in the stock market. And that's one of the reasons the stock market's so high is because the federal funds rate is so low and the traditional savings vehicle is not providing a lot of value. Okay. But what also happens is when we have a recession and they have to go to zero or maybe go negative, it's really going to discourage savings, going to flush a lot of that savings out. It may be a good time for you to take your money out of savings now and redeploy that into other safer areas. And I'm not talking about putting it in market investments. It's not what I recommend right now. I've got several other videos on my channel which talk about the risks there. I won't go over that again here, but you may want to go back and look at those. There is legal risk around keeping your money in certain investments, and there's also market risk. You want to understand those risks before you put your money in those investments. I would actually advocate taking it out of the system and putting it into ultra-safe vehicles, which I talk quite a bit about on my channel: gold, silver, farmland, barterable goods that will last on the shelf. And also skills, increasing your education so that you can have a chance to go get a job in the job market, which is probably one of the most under talked about areas in finance. Everybody wants you to buy their paper, but they won't talk about you improving yourself or having stocks of goods that you can utilize when we have a recession. So there's a lot of good charts here just talking about how, this was the nominal federal funds rate versus the 10-year Treasury yield, and you can see there's a strong correlation there. And you can see that the federal funds rates actually popped up here, so we could expect that the 10-year Treasury yields may rise a little bit. But they haven't. You see as this crossed here, they've risen just a little bit, but not as much. Which tells me there's more fear about the short term than there is the long term. So again, I just wanted to go over these two sections today for this video and make a real quick video. I'm going to do a series of quick videos. But so far, I've showed you two aspects of Yardeni research, one on interest rates and one on daily markets overview, that gives you a wealth of information in chart form that's easy to absorb even if you don't have a lot of experience in markets. And once you start looking at these things, you can start to see relationships which will help you understand what the market is doing, and so that you don't have to guess. You can see the effect of different things on the market. And it's so easy to come here and do this. You don't have to compile the data yourself. It would take you 10 minutes a day to go through some of these things. In fact, when you figure out the key things for you that you're looking for, whether it's helping you planning your investing, helping you planning your budget and savings, and where you want to put your money, it may take you 2 to 3 minutes a day, or you may just do it 2 to 3 times a week. And what I would encourage you to do is at your lunch break when you have a free moment, pull up some of this information. Just do it on your lunch break for 5 to 10 minutes. Or when you get home and the family's settled and you have a few moments before you go to bed, just look at some of this information and think about, tomorrow what do I need to do, or what do I need to think about in terms of our investments and our savings and our personal budgets. Anyway, it's about 12 minutes so far in that video, guys. I'm going to make this one really short, and I'm going to do a series of other videos. There is a ton of information to go over at Yardeni. I'm not going to hit every one of these, but I'm going to hit a lot of them that I think are very valuable, and I'm going to be releasing videos on that for you. Hopefully throughout this series, I'll explain how I use this data to examine my portfolio and what the relationships would be that will really help you. And maybe through about an hour of study through this series, you'll have a really good grasp and handle on the data and how to use the data to your advantage. I really want to make this short and quick and impactful so that it doesn't take long for you to take this information and run with it. Because I'll say, as I've said many times before, I don't think we have a lot of time before the next recession hits. We need to do a quick study. We need access to a lot of information that's impactful, that's free, and that will help you make decisions. And this is a good start. And I want to thank Dr. Yardeni for putting this information out for the public, because I think it will greatly benefit the public.
This has been a Gold Silver Pros production. Please subscribe to us on YouTube and sign up for our newsletter on goldsilverpros.com.